you. Okay. Do. Okay, 5, 4, 3, 2, 1. Good afternoon and welcome to this week's edition of the Daily Energy Markets podcast. This month in review, outlook year ahead. It's sort of the last of the year, so it's kind of like nearly year in review or year ahead in some regards. But let's kick off with Mike Muller, head of Vitol Asia. Mike, I suppose the month in review has got a few things in it, but the most immediate and welcome your thoughts on is the OPEC Plus decision last week to roll over their cuts for another few months, or as it would maybe more appropriately phrased, have decided not to increase supply from January 1st. Oil prices had kind of that built in, and since the decision mid last week has come off a few dollars, now trading a little bit above $71 on Brent. So, Mike, your thoughts on the decision and the direction of travel for this market now that that decision is behind us?
Yes, I think it's fair to say the market got what it expected, more or less. So the continuation of the cuts is, of course, a question of adherence and plain evidence. And some saw this as a major success for OPEC and OPEC Plus, on the basis that people had downplayed the change of a face-to-face meeting to a virtual online meeting. Some read into it because there was a slight deferral in the agenda and the timescale, that was evidence that there was a requirement to do more behind the doors diplomacy. But the result was very much what the market was expecting and the market needed. And out of it, we have a strong, cohesive message from OPEC, OPEC Plus, that the market can work with. The problem is it also signified an acceptance on the part of OPEC Plus that number one, demand in certain important growth markets in the world, notably China, remains disappointing, and an acceptance also that non-OPEC production increases next year will, for the most part, satisfy global demand growth. And hence, the challenge that OPEC Plus need to face is that they need to keep supply off the market for yet longer. Rather telling, however, that there was emphasis on adherence from certain countries that were named, and most importantly, that the phase back to full production capacity was extended to very much the end of 2026. And people then run their balances, and they still see stock builds for the most part. Some consulting shops now have the market a lot more balanced the next year. One even has the market drawing, but I think most people still see the challenge in OPEC's hands. Should there be disappointing demands? Should there not be an extremely cold winter drawing away at inventories? Should there not be a disruption of a major supply source? And the only one people can think about is perhaps increased sanctions on Iran, causing there to be a market drop in Iranian availability to market, further underlined by another set of sanctions on ship owners, for example. Failing all that, the market still has to contend with builds. That said, we're in the top demand period of the year right now. We have crude stocks drawing somewhat, product stocks building, and product stocks are seen to build through Q1. That's normal seasonal behavior. We do have rather interesting early refinery turnarounds in January, and therefore we have a phenomenon where the market is currently rebuilding inventory after refining capacity was temporarily in October taken back because margins had been quite poor in September. And the prospect now is such that we're not going to see quite the volume of products restocking and products builds. You're likely to see more crude inventory coming back into the market. The market is less supplied than it was at certain times in 2024 in terms of inventory, and that's normal at this time of year, of course. But it gives some cause for optimism. And I think the one conclusion most people are drawing is the availability of crude next year will be such, ample, if you like, will be such that the prospects for refining margins are looking a lot better in people's minds than they were when we had run cuts and pretty nasty margins. Well, that's a strong word. Pretty poor margins at the end of Q3 and early in Q4. So the market got what it wanted in short, and I think OPEC did what they needed. And I think Prince Abdulaziz bin Salman was quoted as saying this was a reality check and a necessity.
Well, let's maybe come back to that comment. Christoph Ruhl, a senior research scholar, Center on Global Energy Policy at Columbia University. Christoph, the month in review, as we noted just there, ended with the OPEC decision in the last week, at the end of last week, but of course started a month ago with the election of Donald Trump and all sorts of appointments that he has made since then as kind of a big part of the month in review, at least on the political / moving into economic policy. Your thoughts on the month in review, taking all of those things into consideration?
Well, let me start with where Mike ended. So to me,
Yeah.
the OPEC decision, this is like getting deeper and deeper into a corner, which we mentioned last time already, because it becomes very clear that supply outside OPEC plus supplies will grow out demand growth next year. And this is like a lot like whistling in a very dark forest now. When I hear statements, so, oh yeah, we had to do it because the first quarter is always one which is bad for cuts because it's bad for demand. That's a completely new discovery, of course. So it sounds really like whistling in the dark. And I think what they do is just frankly bet on more sort of geopolitical disruptions like in Iran and elsewhere. Otherwise, for us who do the numbers, for the number guys, it's still an open question when we will reach a plateau in oil demand, and it may well be in the late 20s before 2030. And once that happens, under current configurations with OPEC Plus having these 6.5 billion barrels per day cuts and the adherence, the coherence of the organizations are not very strong, this will mean that it will be very hard for them to control it or to get the kind of volumes out which they had predicted. Now, this reads nicely over to Trump. So 2 points I would make, I think, are important. One, if I dabble in politics, I would say it is, in a way, a very smooth transition, especially compared to the last time he was elected president. So clearly preparated, clear direction of travel, actually impressive the speed with which people have been put into place and the lack of noise compared to what many of us expected in the process. So that indicates that that this is a president, to me, and this is where I would dabble now into politics, who will be very concerned not only about his program, but also in executing a lot of stuff in these only 4 years he has, and about his legacy. Right? So this will be something who is, as we all know, has certain characteristics, and one of them is that he wants to look good, and he will do his best to look good, not only for some crazy right fringe lunatics, not only driven by hatred, as many people suspect, but really by leaving a legacy of a strong economy, of a stronger country. And that actually bodes well for the economics of this presidency. And there may be conflicts along the road, but there will be not this all to the brink pushing of trade wars, hopefully. There's another observation here, which I had, excuse me.
Have a drink of water if you have.
This month or this last week was not only sort of the start of the Trump transition. There was a very important development also in Europe, which was the finally coming to terms on a free trade agreement between the European Union and Mercosur, the bloc of large South American countries, Uruguay, Argentina, and Brazil in particular. It hasn't been signed yet, but it has been unblocked. And this is the kind of reaction you would probably expect in many places of the world, that there will be a network of independent free trade agreements, which will stem sort of the tide of the trade war threats coming from the US. I was in Oman at a big conference last week, and there was the representative of the GCC in these trade agreement negotiations, and he sort of played the same song, saying that we need to establish a network. And the appetite for free trade agreements across the world, outside China, India, outside the US, China, US, Canada, US, Mexico borders, is growing and is very large. And that, of course, might well be a positive development overall, since the WTO has not been proven very effective. So overall, I think much of the rhetoric, I hope, will turn out to be more heat than light. He will certainly have his imprint on the Middle East, and therefore probably restrict oil demand, oil supply, in the way Mike has said in Iran. And overall, this is not a hopeless situation for the rest of the world being confronted and forced to kiss the ring. And there's many things that can be done. And a network of bilateral free trade zones is one of the most effective ways of making a globalized economy more stable.
Mike, just to pick up on your last comment, and the one I think, as you noted, the Saudi energy minister mentioned in his interviews around the meeting last week, which is the idea of a reality check. It's a quote, it's one to take out, but ultimately, what's your interpretation of what that means? What sort of reality check does OPEC Plus oil producers have in mind, and do they
It's
have the
very
right ones?
No, it's very simply acknowledgement that global oil demand, in terms of year-on-year growth, has been revised down by everybody to a point where, if you exclude NGLs, growth in NGLs is coming because there's obviously an onset of plenty of extra natural gas projects around the world, LNG projects, etc. The net growth for oil that goes into traditional refining processes is less than 1 million barrels a day in most people's books year on year, which is back to or slightly below trend line, if you like, after a set of years where growth was a lot more healthy. Much of which, of course, was still the recovery from COVID demand shock. And in certain parts of the world, the aviation sector still hasn't quite returned to those rosy levels, of course. So that's it. That's the long and short of it, I think. That's what I think is referred to by a reality check. Of course, there's a lot of watching of actual output and statistics, and a lot of focus on shipping, and a lot of focus on sources of sanctioned oil, because they are such significant amounts of oil coming into market. And we mustn't take our eyes off Russian supplies, because that is a very, very massive piece of the equation.
And Mike, just to follow up on the same question with Christoph, vis-a-vis the month in review, that Trump's return, and now we've a month sort of a window on how he's putting together his team and policy and the energy side and so forth. Going into through the election cycle, it was always seen as, the famous comment, drill baby drill, more oil, more gas coming out of the US under a Trump presidency. Your thoughts a month in? Do you expect that into the new year? Will that just sort of magically be a factor that has to be taken into consideration in 2025?
It's super hard to form an opinion on this. So, I mean, colleagues and friends in the US, I wouldn't say they're divided. They're all pretty neutral on whether a Trump administration incoming in January is going to be bullish or bearish the oil price. Of course, it would suit him to have a little bit of deflationary factor from lower energy costs, but the US economy, as we all know, is pretty self-sufficient in hydrocarbons. So, if anything, they're exporting diesel, crude, and natural gas in a pretty big way. And as you said already, I mean, he's likely to be less restrictive on opening up certain areas of the country for environmental reasons to drilling. That's that little catchphrase, baby drill, yes. But I think a oil price that would move into the 60s, I mean, WTI is already in the high 60s, Brent's holding 71, 72, is not a price that OPEC should be all that unhappy about given the current set of circumstances, but is also not a price that consuming nations are struggling to accept. Indeed, the best bellwether of acceptability of prices in terms of balancing budgets of energy consuming nations, energy importing nations, is South Asia and LNG. And we've seen quite a step change there in terms of countries that would normally stop acquiring LNG when the price moves from the $10, $11, $12 per MMBTU range to the mid-teens, or indeed higher now. The forward curve is closer to $20. Those people are now buying. So there's been a bit of a change in acceptance there that's a new reality. And the affordability seems to have, or the ability to pay seems to have gone up. So there are many factors here, but I think the other thing to bear in mind is if you were to see WTI going to the 50s, people will start looking at whether that has people scrutinizing rig deployment in a Permian Basin, in a shale environment that has changed a lot from where it was when the prices last dipped, because there's been so much consolidation into the hands of larger oil majors and very large Permian producers. And what it does to the balance sheets of some pretty large listed companies may not be what the Trump administration wants to see either, because then you'll have Exxon's and Chevron's no longer surplusing profits and dividends. Yeah.
And they don't want to see it either, right? They want to have their profitability, and they have a much greater control of the Permian now and the shale patch in a way that they maybe didn't have in the last Trump presidency. Christoph, the moments in the last month in which we've seen prices break out of this sort of tight low 70s band has been in elevated moments of geopolitical concern to energy infrastructure that might be caught up in some of the wars that are ongoing. And now that's come out of it. But today, of course, spectacular news out of Syria. The Assad regime has fallen after close to 50 years. It's quite a phenomenal outcome. And after 14 or so years that this internal conflict has been taking place in Syria, President Assad has fled the country. Your thoughts, Christoph, on what that might mean? Is that going to see the market spike in the morning? Is it not? Your thoughts on that as an event and its dominoes and where they might fall?
My first thought on that was so much for Obama's red lines. But
Yes.
so this was a long time coming.
Could have saved a lot of strife if he had enforced it.
Yes, it would have. And that's, of course, again, a Trump line, which sort of proved not to be completely out of reality. But I have no more thoughts than anybody else in this. I think it will not have a major impact on oil markets precisely because the speed with which it happens reveals the fragility of that regime and that they did have it coming, and precisely because there's no big sympathies around to defend that regime, not even among its closest friends now, the very close ones, Russia and Iran, being too stretched elsewhere, which from the perspective of global peace probably is a good thing. And the further away, sort of more ethnically friendly, having backed off a long time from that crazy situation, with Turkey probably emerging as a winner, and with Kurdistan, these being the oil province, but these are not significant changes in global oil markets. I can't see them. What I do have an opinion on is what you asked earlier, namely what Trump may mean for oil prices. And I think there the logic is pretty clear. Trump means low oil prices if he has it his way. First of all, because of politics. So when he succeeds in establishing some sort of ceasefire in Ukraine, and if he succeeds by siding more closely with Israel and pushing the current policy, which frankly doesn't look pretty, but seems to be very successful from the point of view of Israel and the US, pushing that a little further, then these are things which bring on more Russian supplies. These are things which will not necessarily forever eliminate all the Iranian or Venezuelan supplies, but bring producers in line and increase the pressure on oil supplies globally. And I think that Trump, by his whole history and by his whole previous statements, including about OPEC, by the way, is not somebody who will help US companies to restrain production in any way. He will free up additional land that will take time to come online. He will rely, and he can rely, on a shale patch, which is now indeed controlled much better by big companies. And that means, to me, it's much more nimble, much more flexible, much faster to react in scaling production up and down. Oil and will remain competitive. I don't think he will support any kind of US joining OPEC Plus dreams. That is all way too complicated. He will have low oil prices because it's good for his economy, because it's good for his voting base. These are guys driving big pickup trucks. These are not guys wanting to buy a Tesla and saving their dollars for that. And wherever I can see, his incentives are straightforward, and it is a world of low energy prices.
You mentioned Christoph earlier that rolled into your earlier comment that the peak oil demand question or outline, the IEA one in particular, which is seeing things this decade by 2030. Obviously, OPEC is way further out, but with the return of Trump and the return of his agenda, whatever your date is and whatever his view on the peak date, do you think that moves out a few years with Trump's return, banishing the transition policies of the Biden administration, or all remains the same more or less after you wash out everything?
There are two effects. This kind of predicted policies of Trump of making oil supplies easily available will have a small one and a big one. The smaller one is that, as you said, when you look at the people who advocate for petro, conceptually, what they all focus on is demand. because we all realize there's enough oil in the world. Now the question is how fast is demand coming down to lead to this peak? One element, but it's still a small element of this demand equation, is the share of electric cars in transport. And more than 60% of oil still goes into transport, a large chunk of oil demand growth, although diminishing. And this is where EVs come in, potentially bringing down oil demand for the transport sector. That is still a very minor thing and still very slow. And I think one has to redo the numbers, but a few years ago, the potential of outlawing, of banning certain plastics, plastic bags, plastic things which can be implemented quite easily if environmental movement grows stronger, was larger than that of the projections for the share taken out by EVs. So one has to redo these numbers, but there are elements of a broader economic environmental agenda which also play a role. This overall is still relatively small, but could improve oil efficiency. The other bigger one is, of course, prices. If prices indeed enter a phases of 50 or 60, or if indeed OPEC finds itself in this corner and at some point lashes out and does what they did in the 80s and swamps the market in order to regain control, then that would delay peak oil demand, certainly, because it would increase the demand for oil because of cheap prices. But this is still a very speculative prospect.
Mike, just picking up on that earlier point, the geopolitical price spikes we've seen throughout 2024, when moments of elevated uncertainty came along, most notably Iran, Israel facing off on a few occasions this year. Now with these developments in Syria, it catches at a time when the oil market looks diluted of an oil of a geopolitical risk premium. Your thoughts on that? Do you expect that to return? How do you see the market positioning for this scale of geopolitical outlook uncertainty?
Well, the turbulence in Gaza and in southern Lebanon didn't have much impact because the world, or the trading community, very quickly concluded that the threat to supplies was limited, contained, and whilst there were some preemptive, precautionary shut-ins of the sort of gas production offshore in the Levant end of the Mediterranean, that didn't last very long. So I think Syria falls into the same bucket. I mean, Syrian oil output and oil exports have been highly informal and overland at best. So all the oil majors operating in the country have been away for a very, very long time. But I think you look at the impacts and you get very good indicators from the shipping world. If you look at tanker rates, they have all come down quite a lot since versus the first half of this year and last year's average. And that's a tanker market that's still avoiding the Red Sea because of the disruption threat by the Houthis. You see it in not just the cost of oil tankers, but all other classes of shipping also. That said, you still have rather healthy markets for bunker fuel because the longer distance that's being covered. So one of the factors that has been playing in there is shipbuilding. The shipping industry has seen a higher for longer set of rates, and of course that means their order books are swelling and the yards are very, very busy churning out new ships. The other thing I would say about geopolitics is sanctioned oil has managed to find its way into markets at price levels that are astonishingly flattering for the sellers of those sanctioned barrels. The indicator that I would just bring to the fore here is a few weeks ago, an independent refinery in Shandong in China acquired some West African and some Brazilian oil. They hadn't done so for quite some time because they were absolutely saturated in Pacific Russian and also Mediterranean Russian, Urals. And I asked my Chinese colleagues what to make of it, and it was, well, you know, the economics of the Atlantic Basin non-sanctioned oil from South America and from West Africa was better. So that's telling us that almost full market prices being achieved for sanctioned oil, despite price caps, despite dark fleets being sanctioned, despite tightening measures on the supply chain, including insurance and banking channels. So the market has become awfully efficient.
Well, I suppose the lower the oil price has gone, the closer those two things have come together in essence. that has made the sanctioned oil. The Russian is what is it, $60 on the price cap?
That's right. But there's another thing that you get when, I mean, history tells us this. When you get lower prices, I'm not talking about $72 Brent, but if it were to dip materially from here, China has a tendency to fill up their strategic inventory and their commercial inventory at government direction, and they have quite a lot of space to do that. They also have quite a lot of refining capacity if they wanted to bring it on. So you would normally see a slightly louder sucking sound from China in terms of strategic restocking.
Christoph, let's just close out with some closing thoughts looking forward from a European point of view. You're going to Germany for Christmas. Elections now facing Germany in the new year. France is looking politically paralyzed, and Germany will be, due to the elections, in that same situation for at least a few months into the new year. Europe's two biggest heavyweights in political paralysis at a time when Trump is returning and looking like he's going to be maybe insisting on a certain solution in Ukraine that Europe mightn't like. Your thoughts on all those things that are crossing over in the first quarter, how they might play out and their ramifications for energy flows?
It's quite a situation where you have sort of France and Germany is paralyzed to that degree, also in economics, where you have strength signals of strength coming from Italy, where you have Greece bond rates being more favorable than France's bond rates for the first time in I don't know how many decades.
Ever, probably.
Where you have the one other pole of stability, just because elections have been very recent in the UK, being again a liberal socialist leftist government.
How about Korea? That was a surprise.
Yeah,
that was another
that's
one.
True. And that's not over yet.
I think, yeah, but it's a blip, no? So I understand it. In Europe, it's more dangerous. But I think what we're starting to see in Europe is hopefully that there are some merits to being conservative, and that you cannot always just, let the bureaucracy grow and nothing else. The situation in places like Germany in terms of this government bureaucracy versus private sector is awful. And I don't expect it to be much different in France. And I think that the success stories, to some degree, which we've seen, especially in Greece, but also to some degree in Italy, probably herald, a sort of more open mindset that there is something like people taking responsibility for themselves. And this might be reflected in elections. Unfortunately, the corollary of the current paralysis is really that then people move to the other extreme, and it's this very much this rise of really right-wing populist parties, which also is not going to be a solution to anything. Because Europe probably doesn't have the luxury of the US having 4 years of trials and testing, and then 4 years pause, and then try it again in a more refined fashion. So I think that, lo and behold, these kind of changes, they have to come. And I just hope they don't overshoot too much. That's what I would say on Europe. Otherwise, everything has been said on Europe. Everybody knows what needs to be done. And it's a matter of time and how dire the circumstances really need to become to push people to actually do it.
Closing thought for you, Mike. China. Going into the new year, obviously the big holiday in China, but also how China reacts to this Trump administration with tariffs imposed on China. We've seen them in the last week ban the export of rare earth minerals, for example. How do you see China in the first quarter playing out vis-a-vis both its annual cycle, but now taking on board China tariffs? Economic growth might be more difficult. Your thoughts?
Yes, I'm not always fully aligned with Christoph on China. I've always been a little bit more upbeat. I think China is all about petrochemicals. That's the story. The investment that's gone into petrochemicals capacity is mirroring an expectation that there'll be phenomenal growth in petrochemicals, unlike oil. And that's why you've seen a strong pivoting of all new refining projects into almost using up the entire output of the refinery part of a petrochemicals complex with petrochemicals. So we think that deserves some credit. And if you look at oil demand growth in China, it is a very, very large way, naphtha and LPG. Those are very, very large and growing trade flows, and most people are deploying a lot of effort there. The other point I've already made, which is that China is likely to look at its strategic inventories should oil prices go any lower. And of course, China will continue to find ways to benefit from sanctioned oil, as does India. And so that's something that has been largely contoned and not interfered with. And I guess many people are now eyeing up the Trump administration to see whether there's going to be any tit-for-tat tariff escalation, which could also impact oil supply flows into China. But yes, in summary, it's all about petrochemicals. China has the capacity to grow, but urbanization and population growth is kind of done. And as such, we think a lot of China's growth is going to be Chinese money being deployed overseas in the Belt and Road parts of the world. And one such example would be the refinery they built in Brunei, for example. So there's the potential for a bit more of that, we feel.
Okay, well, we'll wrap it up there and thank Mike Muller, head of Vitol Asia, for his amazing insights this year and wish him a very Merry Christmas wherever you may end up, Mike. Really appreciate it. Christoph Ruhl, of course, as well. Merry Christmas. Look forward to seeing you both in the new year as we kick off with our Global Energy Outlook Forum on January 9th with the big crystal ball outlook for the year ahead. And until then, I wish you both happy holidays with your families and look forward to catching up with you all soon. All the best, guys. Thank you very much.
Bye-bye.
Bye-bye.